let's get started, Patrick, and talk about these bank failures. You know what's amazing is we shot this show 2 weeks ago, and literally the day after, we started getting this news of SVB. You know, the Silicon Valley Bank was going to maybe go under, and so on and so forth. Then it all kind of went down on Friday through Monday, and then we started getting kind of some dominoes falling. And now we've had four banks, three of them regional, one of them a pretty big bank. Credit Suisse is a huge bank that have failed, and maybe some more. I got to say, I'm hearing from a lot of people, they're a little freaked out. What does this mean? We've seen the kind of contagion, if you will, where people are trying to take out their money and so on and so forth. We've had a little bit of panic in the market, no doubt about it. Let's talk about it, because investors, they want to know, how's this going to affect them?
Well, when you look at what's happening in the U.S., as Canadians, we always have to consider the fact that what happens in the U.S. has a big ripple effect. That saying is that when the U.S. sneezes, Canada catches a cold. It goes right across the board. And certainly what's happening in the banking system over there just causes nervousness at a global level. And of course, what we see here happening in Canada is people are also a little bit nervous. Now, we have to really shine a light on the fact that Canadians' banking system or Canada's banking system is way different than what happens in the US. So money is safe. But what's happening in the US is they're trying to protect from that bank run. People don't understand one fundamental. A lot of people don't understand one fundamental, JG, and that is that we deposit money into the bank and we think, oh, there's our little bundle of cash sitting somewhere in a corner of a vault. And nothing could be further from the truth. The minute you deposit your cash, it's no longer your cash. The bank takes it over and they do what they do with it in terms of investments and lending. And that's what a bank's job is. So what they're afraid of, especially in the US, lesser degree in Canada, would be a bank run where people get really nervous and going, oh my gosh, the banks are collapsing. I got to get my money out. So they all run to the bank to get money out. Well, the bank doesn't have your money.
No, God, please, no.
And so this is where the problems start to, I guess, escalate, and where the feds have to step in and try and calm people down. And that's what's happening actually in the U.S. right now. You hear the narrative, Yellen saying, no problem, the banking system's not at risk. Biden comes out and goes, hey, this is all good. We're here. We got you covered. And I think, a lot of people a lot of people believe that it's always the opposite of what they're saying because they're politicians.
Yeah. So let's. I think we should dive into a couple different things. Number one, what you just said, you opened up the door there. So let's explain that, which is if the bank has, the bank is mandated, and different banks have different mandates, and the U.S. has very different mandates in Canada, which I'll touch on in a second. But essentially, a bank never has more than 3% of its assets in reserve, and sometimes it's much less than that, Patrick, which means they've taken a dollar and leveraged it about 97 times, if you will. Like, the number is astronomical in terms of how much they multiply these dollars, which is why when people want their money and everybody wants it all at once, it creates a big issue. And what's been happening recently is all these banks, and now the microscope's on the majority of these banks. What's happening is most of these banks have had huge depositor decreases in the last 12 months. And that's because interest rates are way up and people are putting their money elsewhere. They're not putting it in the bank. They're putting it in bonds or putting it in different investments. They're just not putting it in cash in the bank because it doesn't get much in cash in the bank, whereas you can get a better rate if you bought a treasury bill or a bond or a money market fund or whatever the case may be. So the point is that depositors are really decreasing quickly. Some of the big banks are releasing 20% decreases and now are actually posting some pretty major operating losses because of this. So that's kind of where the issue starts. Then there's obviously the issue about, how they invest this money and why those returns are not coming in. There's been and every bank has different issues there, where Silicon Valley Bank is heavily into tech, and we'll talk about that in a second. The point is this: even though it's a very different system in the US versus Canada, what happens in the US will reverberate in Canada. Now, I want to read you something here, Patrick, because it's important for everybody to realize the differences between the two banking systems, the Canadian system versus the American system. So let me give you this. Since 2001, okay, so for starters, Canada counts 34 domestic banks in total, whereas the US counts more than 4,000. So that's not a 10x, that's a more than 100x in terms of number of banks the US has versus Canada. Very, very different. The other thing is since 2001, 563 banks have failed in the US compared to zero in Canada, because again, we have a different banking system with different mandates. Since the Great Depression, we've had in the US 9,000 banks fail since the Great Depression. 100 years since 1923, including the Great Depression. It's 100 years, whereas only two regional banks failed in Canada, small regional banks. Very different system. So people can relax around kind of whether or not there's going to be a huge issue across the Canadian banking system. Because, Patrick, I don't know about you, but myself, I don't anticipate a huge banking issue in Canada. That being said, investors will feel this, especially real estate investors, because lending conditions are about to tighten a whole lot more than they have been because of this sneeze in the US.
Well, it is an interesting time, isn't it? So you're right. Canada banks way different. We just a couple of weeks ago talked about OSFI mandating the banks to up their reserve funds in terms of how they're supporting and backing mortgages. Should there be, a bunch of mortgage defaults? Now we know that mortgage defaults are escalating. We'll talk about that later, and we have to pay attention to that. But at the end of the day, banks are not at risk in Canada in the same regard as they are in the U.S. But what is happening and what is interesting, a couple points that we'll hit on, which is, the demand for mortgages has dropped because people can't or don't want a loan or get a loan at these kind of interest rates. The other side of it, back to the problems that, Canada faces given what is happening in the US, is that the interest rates overall are increasing. And where we run into some problems and we're starting to get kind of feedback in terms of when we look into leading indicators, businesses are not borrowing as much money, which then says, okay, well, if they're not borrowing as much money, and by the way, the banks are making offers to businesses to say, come on in and we'll write you a loan. The banks aren't wanting to actually borrow money at these kind of rates, which then at risk is slowing the economy down. So those are kind of leading indicators that we got to pay attention to. But that's all part of what's happening with the banking system. Everybody just gets a little bit nervous. Everything tightens up.
Yeah. So as a real estate investor, here's what I say, Patrick. And I've been thinking about this because as this was happening, I was following this very closely. And I don't follow all the news stories very closely, but this one I knew would have a profound impact on us as real estate investors, because as a real estate investor, we all rely very heavily on the banking system and on banks in order to be our business partners in this business called real estate. So one of the things I project is, if you're a real estate investor and your financial situation is tenuous, you're not necessarily as well capitalized as you should be, your loan to value ratios are a little higher, your leverage is a little higher, this is where the bank gets nervous, and this is where they pull term sheets. This is where you thought you had a deal, but you actually don't have a deal because they yanked that sucker out from under you. So if you're a real estate investor and you're currently sitting on a term sheet and you really want that money, you really want to finalize that deal, I would not be dilly-dallying, Patrick. I told you this the other day in a private conversation where I'm in the middle of a particular big deal right now, where I wanted to sign that paperwork right away. I didn't want to wait. I didn't want to wait a week or 2 or 3 to see what happened. I wanted to sign this paperwork because there's no reason the bank might say, you know what, I'll tell you what, how about we just don't do this deal right now? Let's just take a breath and pause and let this, see what happens in the US. This is what the banks do. So as a real estate investor, you're in the middle of a deal and you want that money, I recommend you sign that paperwork, or at least have a good conversation with your mortgage broker to say, listen, should I sign this or should we wait? Because these deals will disappear. That's my thoughts, Patrick.
Well, no, and I 100% agree. And even if they don't actually pull the loan, what they've done, and I've seen this happen before, I've actually had this happen to me back in 07, 08, right through that whole kind of crisis, if you want to call it that, is they change the deal. So in other words, if you're not signed on that particular deal, they come at you and they go, well, we're just going to add this condition, or we're going to shift this ratio just a little bit. So these are things that, to your point, as everything gets a little bit uncertain, all of the banks tighten up here in Canada because, and let's face it, there's another side of that, which is, okay, it just shows responsibility by the Canadian banking system. So, again, that also gives confidence to other people in the banking system overall. So it's a balance I think the banks got to strike. But as investors, we have to know that's what's happening. So to your point, don't kind of procrastinate in getting that paper signed.
Well, listen, and let's talk about what you just said, because you said something fascinating, which is they may not pull the deal as the example I gave, but they may change the ratios. So what does that mean to investors? What that means is, let's just say a bank had agreed to lend you 80% loan to value. You had $1 million building, they were going to give you $800,000 as an example. They may turn around and say, you know what, we're going to bring that ratio down to 75% loan to value or 70% loan to value, which means they will still do the deal. But Patrick, that means you got to come up as the investor with an extra 50 or 100 grand. And this could be monumental if you're working on many projects at once, or even if you're just getting started. I mean, to pop in an extra 50 or 100 grand into a deal that you didn't plan on could really make the difference between you saying, you know what, I can or I can't. And that's what's going to impact investors from my perspective.
100%. Or they'll ask for more collateral. So, they already asked for your firstborn. They're going to ask for your secondborn as well, because they just want to make sure they're covered.
100%. So these bank failures, Patrick, from my perspective, these are the kinds of ripple effects I think I think investors, including Canadian investors, are going to see. If you're investing in the U.S., that's a completely different story, because they may have a whole different because they may be affected way differently than in Canada. And then there's also for business owners, because we know we get a lot of business owners who watch this show, there's going to be some business repercussions to this, Patrick. Like, for example, we were just told before starting the show, SVB, Silicon Valley Bank, Shopify was one of their big clients. And I know SVB had a lot of merchant processing as part of their business. And if Shopify is impacted, and if you're using Shopify as a business owner, I know you do, Patrick, as a business owner, I know I do in my multiple businesses, this could impact us in terms of getting our money and money flowing. This could be an interruption. Just got to be on top of your game is all. Don't let this just slide under the carpet is what we're saying.
Well, I think you make a really great point here, and something that we as investors need to look at. And even if you don't invest in the stock market, let's consider how nervous things are getting. Shopify over the course of this past year, maybe not even the full year, I think their share value has dropped about 70%. They came back up again, but it's been up and down, and still at the end of the day, it's at really all-time lows. But also to note is that when we look at our 5 big banks, whether it be TD, Scotia, RBC, HSBC, whatever that might be, the point is that their share value has come off a lot too. I want to say 20 and 25%, depending on when you want to look at the numbers, but over the course of, let's say, the past year. It's all to say that, investors overall are nervous. People are just paying attention to what they're doing. And if you're getting nervous about the big banks as well as a Shopify, that really speaks to just, like I say, the nervousness of people in general. And I think that is a leading indicator into what it could create in the future in terms of economy.
And I'll give you one more kind of actionable advice for real estate investors, because as real estate investors, Patrick, we often, we go in and out of cash a lot as real estate investors. And sometimes we're very, very liquid. We refinance a property, we sell a property, and we go from having very little cash in a bank to having lots of cash in a bank. And for some investors watching this show, it's nothing to have 500 grand, 700 grand, $1 million, millions of dollars in the bank. Just keep in mind, folks, in Canada, that is insured up to $100,000, meaning anything beyond that could potentially be at risk. And one actionable item might be to spread some of that money between different banks in order to get a little additional coverage, Patrick. These are good risk mitigating moves that in a time like this may help you sleep better at night.
Well, that's great advice too, by the way, is to have, different banks and not have everything in one bank. And that includes, having your business account with your real estate accounts, with your savings account, your personal accounts. It really is good advice to kind of spread it out between 2 or 3 banks even.
Now, the other thing that this opens up the door to, Patrick, is these bank failures is 2 conversations, is digital currency, cryptocurrency. And I'm kind of lumping those together, even though they're not the same. I'm going to lump those together. And also these swap lines. You brought this up because I know you track this stuff quite closely. So this is where we're seeing kind of some behind the scenes, some of that central bank plumbing has got a lot of activity going on right now as they try to keep all these balls in the air. And so, Patrick, let's talk about swap lines and what that means.
Well, swap lines is where central banks exchange money between themselves. So, for example, Canada has banking system. So we got the Bank of Canada, then we got our banking system. And our banking system is doing business outside of Canada. It's doing business all over the world. So, for example, if Canada needs money because they're doing business in Japan, or they're doing business over in Europe, or in China for that matter, what they are able to do, exchange currency for that a currency that's needed in that country, so that country's currency. So these swap lines go back and forth, and it's all central banks around the world. Now, there's a next phase of this, which is, they don't want to use the term quantitative easing. So this is what is, putting more money into the market. Then, of course, we then increase inflation. And so they're doing bank rescuing, if you will. They're not buying out banks, but they're buying out and paying for these investors that have lost money in these bank failures. And so all of this capital has to come from someplace. And normally what they would do is just fund it. They would put it into the system through some form of quantitative easing. Now, they don't want to do that because they say, well, no, we're not going to do more quantitative easing. But what they do is they do it through these swap lines. And it's a very kind of complex issue. But if you see where's the money going, it's going amongst the central banks, and it's another form of quantitative easing, and they're just not calling it that. So there's a lot behind the scene called quantitative easing that isn't, and there's more money coming into the system. The underlying risk and the underlying impact of that will be devalue of the dollar, and of course more inflation.
Interesting, Patrick, that quantitative easing was, the narrative was that this was like the golden child, and this tactic that was discovered after the great financial crisis really saved the economy. And now that we've been battling this inflation issue, now quantitative easing is the bad guy. It's amazing how this narrative has changed, and now they're not even calling it quantitative easing anymore. Now they're calling it swap lines in order to kind of, muddy the waters a little bit. Just fascinating how they play these games.
Yeah, and they're not calling it swap lines. The swap lines have always been a tool. And it makes sense to have that tool, given that it takes the volatility out of the market. Because, for example, if Canada is doing a swap with the U.S. in terms of the U.S. dollar, give me your U.S. dollars. If on any given day the dollar is going up and down, it just keeps some volatility out of the market in terms of what we have in our bank accounts, as in what the banks have in their accounts. So the swap lines are an effective tool, but what they've done is to use them as a workaround to quantitative easing. And that's really simplified, by the way, but ultimately that's what's happening in behind the scenes. So when we talk about this ongoing conversation about global inflation, what it means to us and how it impacts Canada at the end of the day, they just know that there's money going into the global system, and they're just right now using swap lines as a tool to do that, which is unconventional. And it's a way for them to avoid saying, well, we're going to do quantitative easing because we need to bail out banks and keep banks afloat. Because aside from the fact that these banks have gone down, JG, it's not like these 5 banks or 4 banks are, all alone. There is already a contagion effect that's happening. And so the feds, in terms of where they have to come up with capital, they've got to back a lot. So just as an example, I don't know the exact number, but I'm going to say that, let's say there's $100 billion or $150 billion as a reserve, but it's a reserve against $2 trillion being lent out. Like, it's an absolutely, to your point earlier, you said 3%, and if that's the number, that's great. I don't know what it is, but you got to put that in perspective, and the scope of the money that's flooding the system is just crazy. And so they're guarding it, they're guiding it, and the other banks are at risk. So they're trying to increase reserves, and they're using swap lines as a big tool to do that.
What impact does this have, Patrick? We've seen crypto rally like crazy in the month of March since kind of this started hitting. And, and when I say crypto, I mean specifically Bitcoin. I'm looking at the Bitcoin chart here, and it's gone from, if I look just in the last month, and this is in Canadian dollars, it's gone from 32 and it's now up to 39. It hit a low just literally just before this went down at 28, and then it took off. It's gone up 10 grand in the last essentially 10 days. Actually, it's gone up 10 grand in 10 days. What do you think this does for Bitcoin? What do you think this does for digital currency? Does this help the narrative? Does this change things? What's your thoughts on this? I know it's a big topic.
Okay, so let's break this down a couple different ways. So first off, we have to segment crypto as being a language that covers a lot of different language. I'm not interested in crypto per se. I think there's opportunities in crypto, but it's got third-party risk. Always keep in mind that crypto has the term crypto, even including Ethereum, by the way, has third-party risk. So that means that it can be at the effect of men doing something in the background or people doing something in the background with the system. So third-party risk, that's a kind of a really loose example of that. Then we've got Bitcoin, which really is undeniably no third-party risk. And then we got central bank digital currency that's being introduced, It will be rolled out, and we can have a little conversation about that. So if we break it down in that way, and then the other conversation that we should add to this is precious metals, specifically gold and silver, and probably even put some platinum in there. So you got these buckets. So here's what's happening. As people get nervous, as they see what's happening in the banking system, they go, okay, these previously risk-on assets like Bitcoin, even arguably precious metals, but certainly Bitcoin would fall into that. Precious metals, to a different degree, would fall into what they would call risk-on. But all of a sudden, people are in the banking system. They've got stuff in the stock market. They've got money in the bank, and then they go have money in bonds, and they're going, hold it, this is not safe at all. So they take money out, and they take those risk-on assets, and they are risk-off assets, and they risk-on assets, and they put it in there, becoming risk-off. They trust now that given where they need to put their cash to keep it safe, I need no third-party risk, Bitcoin. I need no third-party risk in terms of gold and silver. So these are alternatives that people are putting their capital into. And of course, bonds are there. People are rushing to bonds. They believe it's safe, but it's not a great return. So there has to be a counterparty risk reduction. That's what people are looking for, because if you got money in the bank, you're at risk. There's, counterparty risk that's involved in that.
Interesting though, Patrick. I think one of the things this could do, and this is the thing I'm watching for, is just how the same way. And I know that this analogy is getting old and it's getting boring, but it did do what we talk about, which is COVID accelerated the move, work from home. It accelerated many existing trends. We know digital currency, crypto, has been a trend. It's been ongoing. It's been happening since 2008, 2009, 2010 is where it started, and it's been constantly getting stronger and stronger and stronger. And this could be the tip of the iceberg that tips that narrative over the edge and really gives it some legs to move forward. I'm curious. That's kind of what I'm watching for, to see, is this that kind of moment where people start going to this? And listen, you got real businesses here that cannot meet payroll because their bank has frozen their funds, because their bank has gone under. That doesn't have to happen very often, that a lot of business owners are saying, holy shit, wait a second, I'm going to move my money into something that I fully control, like some type of crypto vault where it's in a, it's not held by the bank and I can't be at the bank's mercy. It's interesting, Patrick. This could be that moment. I don't know. It's too early to tell.
Well, it is. I don't think it. Let's put it this way. I think that we have to consider a couple things. SVB, as an example, Silicon Valley Bank, was a primary lender. I mean, that's who their clientele were small businesses, and really into the startup businesses as well as the tech industry. Well, those businesses are all now out of luck. They're done. So when you think about the fallout of that, it's going to be impactful, and call it a leading indicator. It takes a while for this to work through the system. So to your point, is it a tipping point? I think we have to really be kind of mindful of the thought process, which is, it's not going to work. We're going to wake up one day. We'll wake up one day and we'll hear all this news. It'll be bad news, etc. But the tipping point is more a reshift of the trajectory. So the trajectory, I believe, has changed. I think we're going to continue to hear about these kind of events happening, and that is going to drive people into these other risk now off alternatives, and Bitcoin is being one of them. So I think that that's a consideration. Again, when you look at precious metals, I always look at precious metals now. I've learned to look at it as, all I'm doing is exchanging fiat currency, which is, as we know, been watered down. There's lots of it in the system, to another currency called gold and silver. So with no third party risk. And the point of that, and I'm not trying to pitch anybody on gold and silver, I'm saying this is what people are doing. And that's why we're seeing a rise in precious metals. I can put, 3 ounces of gold in my jeans. I can go anywhere in the world and exchange that gold for whatever that currency is at that current rate. And so that really makes a huge difference in terms of what I can do with capital and how I can use it. So these are places where people are placing their capital, and it's why we're seeing that increase. It's really a case of demand, and people are moving towards it.
Interesting, I think, what the federal government is doing in the U.S. to bail out this stuff that going on, specifically at SVB, which is they're backing the depositors, not the bank themselves, Patrick. And I don't know. I mean, I'm not a banking expert, and nor have I seen a lot of these bank failures over because like we said, in Canada, there's only ever been 2 in the last 100 years. I've never seen a bank failure. I've never experienced a bank failure. But typically, the Federal Reserve or the federal would back the bank. This time they're saying, no, we're not backing the bank. We're backing the depositors. How's that going to play out? Fascinating new move by the feds.
Well, and that's where it was UBS that bought out Credit Suisse for a pound, like literally. So they came in, somebody else came in and bought whatever was left of them for next to nothing. We'll take on your debt. We'll take on the problem. So I think that's what really they're looking to have happen. And I think it's a good move in terms of the feds. I mean, to your point, neither of us are bank experts. We only see what we see and kind of assess it based on the information we get. But I think it's a good move not to bail out the banks. Bail out the depositors. Got it. I would like to see some of those loans honored, for example, to the small businesses or the startups, because there's literally billions of dollars that is apparently going to be shut down. I mean, I don't have all the information on that, but that's going to have a ripple effect for sure.
The boys at the All In podcast actually say something fascinating, which the companies that SVB backs and invests in, those are the companies that in 5, 10, 15 years, those are the next Googles. They're the next Apples. They're the next Shopifys. They are the next tech leaders. If you wipe that innovation out, that really could hurt the US. Which is very, very interesting. It's all innovation, and it's very, very fascinating that if they wipe that out, this could really affect the U.S., which is already struggling with their global dominance. This could have a big effect on the world.
The All In podcast was great. Chamath even said, he thinks that this literally could set the U.S. back 10 years in terms of technology. Because, as he said, these startups, these tech companies that SVB was backing were really the next leaders in technology. And in his opinion, and he's got a pretty strong view of what goes on in that world, he feels that it could set us back 10 years in terms of technology development. That's huge.
We're going to keep watching this whole bank failures thing. We're going to see what else develops. We are going to see what the repercussions are in Canada as we talk to our various mortgage experts and banking experts. And we'll definitely be bringing this up in the next couple of weeks for sure, Patrick. It'll be a topic we watch closely, no doubt about it.
It's going to be great. It's going to be interesting to watch, though, but I think we have to pay attention for sure.
Bank failures. Done.
If you like what you learned here, go to the description below and subscribe for our free Insiders newsletter, where you can also stay up to date for our upcoming events and our courses.
If you want to see more stuff like this, click here. If you want to see the entire show, click there.